Hi and welcome to Random Rogers Big Picture for the week of May 4th. Nothing too big this week, just pick off a couple of small items, so to speak. First up, ProShares listed a couple of double short bond funds. One that goes out 7 to 10 years, the other that goes out 20 plus. The one that goes out 20 plus is ticker TBT. The one that goes out 7 to 10 years, I believe, is ticker PST. They sort of match up, for lack of a better term. The 7 to 10 year kind matches up with IEF, and the 20-year plus kind matches up with TLT. I think this is a pretty big deal, assuming they work, and I would want to give them time before doing anything. But it could be kind of an important step in terms of allowing for creating, and we'll get into a little more of this in a second, that whole thread about this global macro business. Let's not worry for right this second about whether you should do it. For people who are inclined to do such a thing, it creates a completely different tool. I can see utility here with regard to maybe somehow pairing a double short with a long, kind of removing, interest rate risk directionally, owning short and long. If interest rates go up, and it seems like that's a good bet that they would go up, reversion to the mean, I think, exists in interest rates. To the extent that happens, the interest rate on both products is going to go up, and the gain in one would offset the loss in the other. Kind of interesting. And in an environment where interest rates are historically quite low, and 10-year below 4% is very low historically. That may be easy to forget, but nonetheless, it is what it is. So I think this is pretty neat. I'm going to probably do a write-up for it for TheStreet.com during the week, TheStreet.com being the free site, so you'll be able to check it out. Okay, next issue. I had a post at the beginning of the week that sort of tried to define alternative asset classes, and Seeking Alpha reran the post, and as they often do, changed the title. They changed it to Defining Asset Classes, just a small tweak. And there's some great comments on that post, some guys going into some detail where they talk about some of the different things that they use in the idea of adding alternative asset classes to their portfolio. They go into specifics about percentages and all of that stuff. So I would feel free to check that out. What's interesting to me, and hopefully this is useful to you, is if you look at it, these guys aren't necessarily trying to, or I guess I should put it this way, they're willing to give up upside in a raging bull market in order to smooth out the ride. They're focused, hopefully they realize this, how about that, on the full stock market cycle as opposed to, making 20% every year, which is not going to happen. So this is pretty interesting. This is Trixie. Kind of interesting to see these comments, to see, hopefully I'm reading this right, that these guys do get it, and their goal really is to smooth out the ride. And I think, to the extent you've been listening to me about this, it's difficult, to hear the same message from the same person over and over. And I think maybe going over to these guys will allow you to explore this. I will be clear and say that I am more active than what this implies, but in the interest of trying to help you find your own way, I've made this comment before, it's intellectually very intriguing and something I'll probably keep writing about. I don't see myself switching to it. I would rather utilize a couple of these sorts of things and integrate them into a diversified portfolio. I made the comment of not wanting to hedge an alternative asset class with alternative asset portfolio with a few equities. I believe in equity portfolios, and I'm looking to hedge with a couple of alternative asset classes. Nonetheless, it's interesting to see this concept applied through someone else's eyes. I write about it a fair bit. Obviously, David Swenson writes about it. I don't know if these guys know what they're doing or not, but it's just interesting to see the perspective, that's all. Next thing is read an article, the ROI article in the column in the Wall Street Journal by Brett Arends, I don't know how to pronounce his name. He threw out a nasty little factoid. The savings rate is now down to, I think it's 0.2 of 1%, which is astonishingly low. At some point, you would have to think, but maybe never. Maybe it's never a problem, but I can't think that doesn't become a problem at some point. We are a nation that seemingly depends on the kindness, relies on the kindness of others, or kindness of strangers, whatever that line is. That is pretty scary implications for the long term, given how certain imbalances and certain deficits seem to be. Hopefully that changes. Someone accused me of mothering the people that read this audience. I prefer to think of it as prattling on myself, but whatever. Save money. That you learn that when you're a child. So save some damn money, for God's sakes. That's what adults do. Is they save money and prepare for their future. Hopefully you're in a position where you are able to do that. I realize I just came on kind of strong, but coming from the standpoint of my wife and I each having a family member who older than I am, virtually destitute, I think we've got the credibility to say that. So save some money. Figure out what you can save and start saving it if you're not already. Important stuff. Alrighty. Short and sweet. That's about it. Have a good weekend.